What you will see in this video: 1. Getting to know the head and shoulders pattern for beginners. 2. The head and shoulders pattern has 4 components. 3. Examining the advantages and disadvantages of the head and shoulders pattern. 4. More explanations about the advantages and disadvantages of the head and shoulders pattern. 5. Examples of the head and shoulders pattern in the financial markets, including forex, crypto, and stock market. What is the head and shoulders pattern? A head and shoulders pattern is used in technical analysis. It is a specific chart formation that predicts a bullish to bearish trend reversal. The pattern appears as a baseline with 3 peaks, where the outside 2 are close in height, and the middle is highest. Left shoulder, price rises, forms a peak, then falls. Head, price rises again, forming a higher peak. Right shoulder, price falls again, then rises, but forms a lower peak than the head. The neckline is a trend line drawn horizontally connecting the low points of the left and right troughs, the shoulders. The neckline serves as a critical level of support. If the price breaks the neckline and closes below it, the pattern has completed. The head and shoulders pattern forms when a price rises to a peak and then declines back to the base of the prior up move. Then, the price rises above the previous peak to form the head, and then declines back to the original base. Finally, the price peaks again at about the level of the first peak of the formation before falling back down. The head and shoulders pattern is considered one of the most reliable trend reversal patterns. It is one of several top patterns that signal, with varying degrees of accuracy, that an upward trend is nearing its end. A head and shoulders pattern has 4 components. 1. After long bullish trends, the price rises to a peak and subsequently declines to form a trough. 2. The price rises again to form a second high substantially above the initial peak and declines again. 3. The price rises a third time, but only to the first peak level, before declining again. 4. The neckline, drawn at the 2 troughs or peaks. Advantages and disadvantages of the head and shoulders pattern. Advantages: 1. Experienced traders identify it easily. 2. Define profit and risk. 3. Big market movements can be profited from. 4. Can be used in all markets. Disadvantages: 1. Novice traders may miss it. 2. Large stop-loss distances possible. 3. Unfavorable risk-to-reward possible. Advantages explained: 1. Experienced traders identify it easily. The pattern is very recognizable to an experienced trader. 2. Define profit and risk. Short and long entry levels and stop distance can be clearly defined with confirmation openings and closings. 3. Big market movements can be profited from. The time frame for a head and shoulders pattern is fairly long, so a market can move significantly from entry to close price. 4. Can be used in all markets. The pattern can be used in forex and stock trading. Disadvantages explained: 1. Novice traders might miss it. The head and shoulders pattern may not present with a flat neckline. It may be skewed, which can throw off new traders. 2. Large stop-loss distances possible. Large downward movement over long time frames can result in a large stop distance. 3. Neckline can appear to move. If the price pulls back, the neckline might be retested, confusing some traders.